sort of marshalling the resources and sort of sitting on top of the resources from a financial perspective in order to keep the engine running, as it were. And so when you think about stacking up revenues and costs, which is, from my perspective, the first thing that you should do is make a list of all the sources of revenue and make a list of all the sources of cost. That'll give you a good barometer for, does this go around in my current, in my current thought process. And so if you just very quickly, take crayons and think about all the different revenues that you might have, and this was without knowing which projects you were working on, trying to cover the whole gamut of places where you could derive revenues from. Clearly that's not an exhaustive list, but that covers a spectrum. You can be gaining revenues from contracting, consulting, grants, loans, revenue sharing, leasing, thought leadership, which could be everything from speaking engagements through to paid publications, licensing IP like software, recurring subscriptions, debt. That's probably not the most sustainable way to go, but it does often help you get through that growth phase and into a more sustained operational long-term run, and that actually will get into how to effectively use revenues and debt to get yourself over the hump. We'll refer to it as escaping gravity. It's very rare that a business starts off being wildly profitable at the gate. It does happen. There are some examples that you can point to, but there are not very many. In fact, quite the opposite. You'll typically look at businesses struggle along for a number of years before they crack that or get to that point where revenues actually exceed costs, and we'll call that the escape gravity moment. And I'll get to that in some of the numbers coming up. On the cost side, unfortunately, there's too many of those. Everything from salaries to travel and all the pieces in between. Legal advice, I can tell you that one definitely adds up quickly. IT, insurance. Hopefully, none of the lawyers I work with will hear that moment. I'm actually meeting them for dinner tonight, so I'll apologize to them then. Interest expenses, insurance, information technology. So really, you have to be fairly comprehensive when you think about your costs, and I would very much encourage you to think about all the boring stuff, because that's the stuff that will catch you out. It's not necessarily the things that you think might catch you. It will be the things like IT and legal and insurance, and unforeseen supplies and travel. All of those pieces, when they seem like small line items when you're thinking about them on a one-off basis, but I really encourage you to think about and frame those up. And if anything, give yourself more buffer than you think you'll need, because that's actually some of those pieces, they accelerate quickly, and giving yourself more space and time by taking a pretty aggressive view of your cost lines will help you understand how you need to frame things. Because one of the worst things that you can do when you go out to raise capital or get in front of investors is undersell how much you need, because you want to reduce the number of times that you need to go back to them before you escape gravity. So every funding round that you need to do is dilutive for a founder, and so what you want to be doing is minimizing the number of times you need to go back and raise capital, whether that's from friends and family or from institutional investors. It's always a difficult conversation with the investors when you're asking for more. Yeah.
Could you please explain again what thought leadership is?
Yeah, so thought leadership, that could be anything from paid speaking engagements to research papers that are published, to white papers, thought papers. So it's not uncommon for experts in the field to either charge speaking fees, or they could have a publication that they put out, and it could be anywhere between £50 and £5,000 or £25,000, depending on what the content is and how many people they think are going to be subscribed to it.
Especially as a young enterprise, is it favorable having different streams of revenue?
Good question. I'm going to say, in most cases, actually not. And I'm speaking from a large investor's perspective, because they'll look for focus, and they'll look to see, is this business focused on driving maximum efficiency out of one, maybe two things. I think the challenge becomes if management's time is split amongst a number of tasks, it just reduces the efficiency that each of those tasks can operate at. So I would say that definitely in the medium term and the long run, that's fantastic. And I'll put another qualifier on it. If one of the sources of revenue is not something that requires a high degree of management time or resource, like recurring subscription revenue, recurring revenue that doesn't require active management is the holy grail. So if you have that plus something else, phenomenal. People love that. If you have thought leadership, and you're also licensing IP, which means you're probably creating something that needs to be actively managed, and you have a product cycle that you've got to continually be investing management time in, that would be actually a bit of a red flag, because now you've got management pulled between trying to put out thought leadership pieces, flying around, giving speeches, and trying to develop licensed IP. And so that will actually cause probably some concern from an investor's perspective. But if you had IP licensing and recurring subscription revenue, that would be fantastic. So it's there's a couple of different ways of looking at that, and I would say that if you can make the case that management's time is efficiently used, then yes, multiple sources is good. But it would probably be, people will dig into that definitely, certainly from the funder's perspective, because they'll want to know that you're going to be able to execute against what you've promised to do. Does that answer the question effectively? So the fun part, understanding financial statements. I think it's probably fair to say there's more than three, but there's three key financial statements that I believe must be understood when you run a business of any kind. So this is for-profit, non-for-profit. Honestly, like your own household budget. These are things and tools that will help you run an organization of any size, whether it's a one-person business or a 100,000-person business. And so the income statement, I'll tell you briefly what each of them is principally used for. So the income statement is used to determine profitability by subtracting expenses from revenues, and this is the key part, over a discrete period of time. And so that's usually quarterly or annually. Some companies in Japan actually produce them on a decade cycle, which I think is actually really interesting because it gives you a longer range planning horizon, but it's usually a quarter or a year. The balance sheet provides a snapshot of the financial position of the company. Again, this is the critical part, by freezing time and examining assets, liabilities, and shareholder equity. So that's take a snapshot of the business in this moment and then report on those three key items. And then the cash flow statement is my favorite one because it can't be distorted. All movements in cash over that certain period, which are usually quarterly or annual, show up, and you cannot use any tricks. Cash doesn't lie. When you run out of cash, you have no more cash, and so you can't mess around with numbers. I'll get to that in a minute when we go through the other two. But the balance sheet, for example, you can book future revenues. You can do all sorts of things that push and pull things from the past into the future and the future into the past. And so there's ways that you can place things on the income statement and the balance sheet that could potentially distort the situation. But the cash flow statement, there's no tricks. You have the cash that you have, and it creates a visible profile about how that's entering the business and how that's leaving your business. And it's one of the first areas that any investor will go to. In fact, if you structure them in this way, income balance, cash flow, most investors will actually flip straight to the cash flow and go, does this business have enough air to survive? And if the answer is no, they might not actually read the income statement or the balance sheet if they can't get confidence in the cash flow statement. So I would actually also say that ordering your financial statements is important as well.
So at this stage of this business, it's enough to present the cash flow statement. At this stage,
you're right. So that would it's projected cash flow that you'll be. So most investors will ask you for a 3-year or a 5-year business plan, and so it's demonstrating using a reasonable set of assumptions that your 3-year cash flow, for example, your 3rd-year cash flow is going to make sense. And so it's walking them through this is the investing phase, which is typically years 1 and 2. By year 3, break even. By years 4 and 5, you're into a profitable situation. And so you're absolutely right. It's not that you have to show positive cash flow, but you have to show the story from how you're going to get from where you are today to a period of time where you're going to have positive cash flow. Because positive cash flow is really the best analogy to use is the oxygen for the business. Without cash flow, you can't pay rent, you can't pay employees, you can't buy equipment. So,
That flow is usually presented on a monthly basis or in a year basis. Because everything's projected.
Yeah, so on the projections, it typically would be on an annual basis. But then inside of the annual statements, you'll typically have monthly resolution. So as a practical example, we right now in our business run monthly, but then we report quarterly and annual.
But when you are going to raise money,
Yeah.
you would need it like presented in a monthly basis, right? Because, and for example, these kind of projects that we have here,
Yeah.
the expectation is not to have a break even in 4 years. The expectation, I don't know how many months it is gonna take, but not even a year.
Yes. So I would say that the modeling that you do probably should be at monthly resolution, but then rolling it up to an annual presentation so that somebody can look and say year 1, year 2, year 3, year 4, year 5. You'll see in the examples I have coming up, I believe, if I recall, I use 5 years as the example. So it's usually you'll structure them on an annual basis when you're presenting them in a deck. But the model that you have internally, and people will definitely ask you questions about that and may ask to see the monthlies. But I would say start with annual, and then if people want to get under the hood and go into more depth, then that's when you get into the monthly. The monthly, there can be a lot of noise in that as well. So my advice would be to, as much as you can, stay out of the monthly and try and shift the conversation towards annuals. But I think, obviously for your own planning purposes, you should definitely have monthly resolution.
And one last question.
Yeah.
This kind of business doesn't need, like, they are not capital intensive, or how can you forecast, or how can you, I don't know, how do you know what is the proper number of months for a break even? It's difficult.
It is difficult, yeah.
But for example, there are rumors in the market, for example, for a restaurant, I don't know.
Yeah.
3 months. 3 months is like something that people have in mind.
So I would actually say, so that one is definitely, it's very industry and very business model specific. I could point to the most famous example, which is, I don't know, Amazon took 30 years? It was 25 or 30 years before Amazon became cash flow positive. Kept raising money, and kind of these guys, but so I would say it's entirely dependent on the business model. That's one where I don't have a good answer for you, because it depends on the risk inherent in the business. It depends on the aim of the business. It depends on the appetite of the investor or the shareholder. But I would say on a generalized basis, and this is really generalized, usually the answer is about sort of 3-ish years, 2 to 3 years to cash flow break even or profitability is a good barometer for where people will tend to like to see that type of shift. But that can move forward or backward a little bit depending on the risk profile of the business and in particular history and appetite of the investor that he's coming to the table. So the income statement. This looks at revenue and expenses over a period of time. So you'll see here I've used a 5-year example. And again, back to that piece about being able to push things and pull things around. It's performed on an accruals basis and might not actually reflect your cash position. But it's used by investors as a tool to assess 3 things: growth, profitability, and margins. And so I'll flip down to this next piece here and show you kind of inside the head of the investor and how they're going to be looking at that. So if you look from top to bottom, or what's sometimes known as north to south analysis, that's used to understand revenue or margins in any given period. So you can see here, if you go through all of your expenses and then you divide by total revenues, that's going to give you a perspective on how on what percentage of revenue you have left over after expenses. And so in this particular case, you can see that in year 1, running a loss of $62. In year 2, a loss of $104. But revenue is growing steadily. So revenue is growing steadily, expenses are growing steadily to underpin that revenue, but you now have earnings by year 4. So you've got 3 years of investment where you're building and you're building. And so while you're doing that, an investor will look at this and say, okay, what I'm seeing is margin growth along this line. So right now at the bottom, in year 5, I've got total expenses of $262 and total revenues of $600. That means that my expense ratio is 44%, which means that 100 minus 44 and gross margin is 56%. At the same time, they'll be looking at what they refer to as west to east analysis, which is used to understand growth rates by examining year-on-year changes within each line item. So if you go west to east, you can see that you've got a 91% growth rate 91% growth in net income from 22 to 23, and almost a 1,300% increase from 23 to 24. But this is that piece I was talking about earlier where this is the escaping gravity element, where you've got revenues that are growing faster than expenses. And so you invested in that functioning mechanic that now you've got a sustainable business architecture that's underneath that business model. And after you get through that critical period of investment where you build up the team, you get, your advertising starts to work, you've got more clients coming in, and critically you're scaling. So your insurance expenses probably aren't going up at the same rate as your revenues, your software costs aren't going up at the same rate as your revenues, neither your advertising. So you start to get more revenue as a function of the same cost input for a variety of the items. And so you've got scaling effects and also revenue growth and market growth effects. And so it's staying alive long enough for somebody to look at the north-south analysis and the west-east analysis and say, this is a business that's going to have costs that are, yes, rising, but not as quickly as the revenue lines. And so as a result of that, the margins are going from negative to positive, and that area where you escape gravity, and you've got net income that's positive, which ultimately will lead to a repayment of shareholder investment, is going to get to a spot where it's again, also sustainable and growing. I'm going to pause there before I go to the next. Any questions on how people would look at one of these?
With a lot of social businesses, a lot of the revenue could come from grants and other places. How do, and I've asked this before to investors, but I'd love your perspective on this.
Yeah.
How do investors look at that where I do escape gravity, but a lot of that escaping gravity is due to the fact that I have a grant from the MasterCard Foundation, or I have, that will expire in 4 years, or 5 years. How do they feel about that? Like, is there a percentage of the revenue that they feel should come from trading to justify that you have a real business here?
Yeah, I think the short answer to that is yes, unless they can point to a continuation of the grant. Like if they see a potential for a rollover and they're willing to bet on the fact that that might happen, then yes, that's I think the other piece that they might look at is whether or not other line items on the revenue side are growing fast enough to replace the revenue that's being generated by grants over that period of time. So I think if taking the grant line item away meant that this then flipped back into the negative, that would be a harder case for an investor that's seeking a return. But if the investor was interested in, if it was more of a philanthropic type of approach where perhaps they were actually more interested in a tax receipt than they were in a return on investment, then that's just a different type of return on investment. So I think the only question they would have at that point is whether or not if it's a philanthropic or if it's a not-for-profit or ultimately a money-losing venture that is dependent upon grants and philanthropic donations, then I think they would just look for the continuation of that in order to make the decision. I mean, one of the biggest examples of that in the world is the United Way. The United Way runs a campaign every year on the basis of the fact that they can get back up to roughly where they were last year plus a little bit more. So their entire business model is grant-based effectively, whether it's from individuals or institutions. And the reason that those individuals and institutions keep coming back together to provide funding into that model is they believe that everyone else will also do the same. So there are definitely cases to point to where exactly that approach is taken. But I would say that those are probably fewer than ones that have sort of, more stable or more predictable sources of revenue. But it is not, certainly not impossible. So the balance sheet. The balance sheet provides an overview of the financial position of the business frozen at a certain point in time. So if you get to December 31st, you say I want a check on the health of the business, you freeze it, and then you compare assets to liabilities and equity. It's very useful to calculate key financial ratios such as debt load, working capital, and debt to equity ratios. Again, these things will tell a potential investor about the financial health of the business. Again, I should note, these are all things that you would want to structure into a business plan. So this doesn't necessarily mean that your business is up and running. This would be your projection. So this would be based on a set of assumptions. If I believe the following things to be true, these are what my income statements, balance sheets, and cash flow statements will look like. So this is a projection into the future, and this is the story that you're telling your potential investor as you go out to market and try to raise funds. So taking a look at what happens when you analyze some of those ratios, really what the balance sheet does is gives you a snapshot of the underlying health of the business. So it's kind of like going in for an annual physical and having your knee tapped by the hammer, your blood work done, and sort of everything assessed to make sure it's within normal ranges of bounds. So the debt ratio is the ratio that indicates the proportion of total assets that is currently owed to creditors. I think what's important there is that unless you are in startup or high growth mode, you want to keep this below 1, and 0.5 or lower is a good target. If you have a very high debt loading ratio, that's a warning sign, because what it will tell potential investors that the business is over-levered. It's, again, because of the fact that this business is starting up from scratch, it's normal to see it kind of around that 1 to 1.5 mark. But you can see by the time that you go through that point where you escape gravity, it's starting to fall below 1. So by the time you get to year 5 and you're through the point of cash flow break even, and now you're starting to generate enough cash to pay down some debt, your debt ratio, total liabilities to total assets is falling. The current ratio provides a perspective on liquidity, which is how long can the business continue to function given the amount of cash it has available. This one you want to keep above 1, but if you let it get too high, it's a sign that you might not be using your assets effectively. So if you have too much liquidity, an investor would say, well, they would question your ability to reinvest into growth. So that's a trade-off between wanting to stay liquid, which is great, but also wanting to demonstrate growth. And so certainly in the early stages, you want to keep that above 1, but again, going off to, if you hit 10, you've gone too far. The debt to equity ratio is indicative of how a company is financing its operations, and so keeping that ratio positive and low is usually a sign of stability. The other quick note that I'll make is the working capital, which is current assets minus current liabilities, gives a view of how long the business can survive given the present conditions. And so low or negative working capital is a red flag for insolvency or impending default. And so that is another key area that investors will look at. So again, what I've tried to do here is show for each of those ratios how they're calculated over here, and then an example of how that plays out through time as you look at the make-believe company that is structured for the balance sheet. Yeah.
Could you go through the difference between the current ratio and the working capital again, please?
Sure, yeah. So the current ratio is current assets divided by current liabilities. Mm-hmm. So that gives you, whereas the working capital is current assets minus current liabilities.
But
they both examine the same thing.
Okay.
But the current ratio it's just like the quick barometer on liquidity, whereas the working capital will provide you with a view of how long you think the business can survive. So if you had $113 of working capital and you're using up you're using it up at a rate of $50 per year, you would say, well, that business has 2 years to live. And if it drops below zero, or if it ever goes negative, that would be a sign of, if the business doesn't go cash flow positive that year, to bring working capital back up, then it will be insolvent in that fiscal period. Yeah, so maybe the right way to think about that is the current issue is how good, and the working capital question is how long. So how good is it? How long will it last? Or how good or bad is it? And how, as a result, how long will it last? Then the last piece, this one is my favorite again because it's really simple. There's no trickery. There's no bringing the future into the present. There's no delaying the past into the future. This just keeps track of increases and decreases to cash position in a given period. So it's difficult to obfuscate. It's not impossible, but it usually requires fraud. So that's another reason that I like it. It's difficult to mess with. And to reiterate a point I was making earlier, cash behaves like air to a business, and it can't lie. So the cash flow statement, unless somebody just isn't putting a piece of the cash flow information onto it, has to be the truth in that period of time. It determines whether the period is added or subtracted from your cash balance, and how cash balance was influenced is important. So you can see, as an example, in the early years here, where you have net increases in cash, it's coming from borrowing. And whereas later on, where you continue to have net increases in cash, now it's coming from net cash flow from operations. So this is one where investors will look at, the bottom line, obviously, but they'll want to see this starting to go away. In most cases, they'll want to see the borrowing, if not. I mean, I've taken a pretty drastic example where I've dropped the borrowing off entirely, just to illustrate a point. But they'll want to see a decreasing need to borrow and an increasing contribution of net cash flow from operations. And really what that will tell them is that instead of needing to go back and either raise more capital or go to the bank and ask for more money in the form of a loan, you've switched to a mode where the business is earning money from operations and you're actually needing to repay debt. So this is now, you're earning enough to go back to repay some of the borrowings and investment that you had in. Any questions on the cash flow statement?